Good evening, all the joinees. I welcome you all on behalf of NGEN Markets. This is Prajakta. In the meanwhile, others join. Let us introduce the topic for today. Our today webinar discussion will revolve around understanding a detailed analysis of custom securities and how you can onboard the custom security onto NGEN Markets platform. Now, by custom security, we mean anything that is a non-standard asset class. To typically onboard that on the platform, you need to have your own data. That means the time series and the price series is something that has to be provided or rather available with you to enable you to analyze these custom securities or non-standard assets. So typically for mutual funds and stocks, we have the data base ready at our backend. Anything else that you want to analyze, which could be, let's say, a AIF, or for that matter, a foreign ETF, or for that matter, any foreign stock, or any other commodity, right? If you have the time series and the price series, we will see what capability does NGEN offer for you to analyze these in detail, right? In this detailed analysis, we will first of all check how its performance compares with a benchmark. Now, we have a host of benchmarking options. We will see how we can actually change the benchmarks. We can add a customized benchmark to actually benchmark the performance of that particular security against. Next, we will move forward and understand returns distribution analysis on this security as well as on a mutual fund or for that matter even a portfolio. So basically we will discuss what does return distribution analysis mean and how it can be interpreted. Lastly, we will have a look at all the updates that have been made on NGEN Markets, and we will then throw the forum open for a Q&A session. So let us now begin. So for the webinar specific discussion, we are going to initially be focusing on the My Securities tab at the last, right? So this, as you can see on the platform, is the NGEN Markets landing page. This is where the platform will, take you once you log in. For the discussion today, we'll be focusing on this last tab, which is called My Securities, right? So typically, let's first understand how will you load a non-standard asset if the data is what is there with you, right? So for that, you will click on this add a new security icon that you can see at the top in My Securities tab. The moment you click on this, this is the view that will show up in front of your screens, right? Firstly, it says, okay, select an asset class. Is the security that you're trying to analyze, is it an equity? Is it from debt as a category, or is it something like a commodity? In that case, you'll be choosing other as asset class. Next, you'll be providing the system with the data. Now, how will you provide the system with the data? So for that, you just need to have the time series, meaning date series, and price series, that is the NAV series, side by side in two columns into an Excel sheet, right? That's the only data input that is required from your end, right? Now, this data series need not necessarily be a daily data point, right? So for example, there are some not really very liquid bonds, right, that you want to analyze. If of course you have the time series and price series, you can simply copy that from an Excel sheet and paste it here. The time frequency could be any, it could be, let's say, a weekly basis, or for that matter monthly basis. Typically AIFs, right, let's say they release the data points on a monthly basis, right? You can upload those data points here as well. So the frequency with which the data is available is not really a point of concern here. It will get processed even if it's a weekly, daily, or even a monthly frequency data, right? Now let's see how will you copy that from an Excel sheet. So what I have right now ready in front of my screen is the gold as a security and the price series of that. So I've taken this typically from MCX website and downloaded that into an Excel sheet, right? So this is how the layout, or that matter, this is all the data points that you need to have. The first column will be the date. The second column will be the prices. You simply choose all the data points. In this case, we are doing a 5-year analysis. So you choose the entire data points and you simply do a control C, that's copy, right? Then you go back onto NGEN Markets platform, and in this white portion that you can see, you simply paste all of these data points here. So do a simple control V. The moment you do that, You will then be required to click on validate. Only then this entire data that you're looking to upload will actually be validated onto the system. Of course, saving will happen after that. The moment you click on validate, it will show up this blue line, which typically is an indicator that all the points that you were seeing on an Excel sheet have now been plotted as a line graph, right? This is across, across the time period that you have considered, right? So that's July of 2019, when the starting price was 34,801, to the last price, that's last traded price of gold, that's 69,405, which is the last price that you can see here. This was, of course, as on 1st of August 2024, yesterday's price, right? Once this is plotted, then you will put a name to this security, right? So because this is a commodity, right, gold that we are analyzing, so we'll put in gold commodity. And then you will choose an asset class. Because this is a commodity, I'm going to choose in a other as asset class, right? Once this is done, you will click on save. You will see this loading icon. The entire data is now getting saved. Please ensure you do not click anywhere else when this entire process is getting run, so that the security is saved properly. Now, how will you ensure that the security is saved properly? You will see this screen, which was, initially there, which will reappear. That typically is an indication, okay, the data that you are trying to save has properly gotten saved, right? And then you have this folder management system. You see there are these three folders. That's debt, equity, and third folder was others. This is exactly coming in from these three asset classes. Now, because we saved this particular security in others as asset class, you can use this icon to collapse all the folders. So in this case, of course, we have just three folders. So that's debt, equity, and others. We saved this into others. You click on this plus icon, and this is the security that we have just uploaded, right? You click on this, and a detailed analysis on this particular security will be loaded. Now, of course, the start date will be mentioned right here. The data that we had is from 30th of July 2019, and you can definitely look it right here, right? And we have it, of course, till 1st of August 2020. Now, please note, like mutual funds, you will not be given an option to change the start dates here, because for mutual funds, if you would be aware, we always have an option to change the start and end dates, right? That's typically because the database is already there into the platform. You do not provide, you meaning the user does not provide any data points here, right? So therefore, the flexibility to change the data points, or for that matter, the start dates, will always be there. Even this is even the same on a portfolio level. But typically, you will see this change when you're doing the security analysis. That's because you've input this entire time period, 5 years time period, and we are now going to do an analysis on that, right? So there'll be no flexibility of changing in the start dates here. Okay. Now, of course, the asset class is mentioned right here. Now, the first tab that gets opened up when you run this analysis is the performance tab. When you look at this performance tab, you will see these two line charts. The blue, of course, the blue line chart is, of course, of gold, which is the security under consideration. Now, you will see that these are not actual prices or actual NAVs. This is rebalanced. That all of these levels are rebalanced to start from 100, and then a fair comparison is done between the two price series, right? If you now typically want to have the actual data points that we had uploaded on from an Excel sheet to NGEN Markets, you simply can click on this actual NAVs icon by clicking on this checkbox, and these actual NAVs will get shown up. So in this case, you see, so 1st of August, the closing prices are around 69,000 odd, right? And that can be seen right here. Now, in order to do a fair comparison, this is what we load by default, that is rebased prices when you rebase that to 100. Now, this is for the blue line. Now, the black line that you can see on the line chart is representative of the benchmark, which in this case is Nifty 50, right? And of course, you can change the benchmarks as per your requirement from this benchmark tab right here on the extreme right-hand side. Currently, we are benchmarking gold against Nifty 50, which is benchmarking gold as a security or commodity against an equity broad-based index. Right? Now, when we're comparing this, we can definitely compare cross with various parameters. So for an example, cumulative return. That means point to point absolute return of gold against that of the benchmark is mentioned right here. That's cumulative return. So gold returned about 100%. 34,000 odd became 69,000, right? So that's almost 100% return, right? So that's exactly what you can see with respect to the asset. That's gold. On the other hand, benchmark, which in this case is Nifty 50, given in the same time period of the last 5 years, 2019 onwards, actually given 125% return. And that is exactly being highlighted here. Right? So this is cumulative or absolute point to point returns of each of these securities side by side. On the other hand, how volatile were each of these securities during the entire time period of 5 years can be located by having a look at the annual volatility number. Annual volatility is a measure of risk which is measured by taking into consideration the standard deviation of every data point that you can see on this line chart with respect to its average return, right? So that's how standard deviation is calculated. You can typically see gold has much lesser standard deviation as compared to that of the benchmark itself, which is of course in this case index, that's Nifty 50. Other than this, the Sharpe ratio typically indicates what were the risk adjusted returns, right? So to generate 99, almost 100% level of risk, gold undertook a volatility, or rather assumed a volatility of about 13.5%. The same thing for benchmark, it took 19% volatility. It assumed a 19% risk to generate, of course, a excess return of almost a 125% higher return, right? Therefore, you see risk adjusted ratio, if you consider risk adjusted returns, the Sharpe ratio of the benchmark appears to be better than the security itself, which is gold in this case, right? Next, let's come to excess return on benchmark. So in this case, you see when the benchmark given 125% return, the gold as security given just about 100%. So that's a difference, or rather a negative excess of 26%. So gold gave a lesser return of about 26%. And that is what exactly you can see in cumulative excess on benchmark. Now, let us interpret the chart that you can see right here. So typically during COVID onset, right, when there was a time of 2020, right, it was gold which actually was very, very resilient even during this downfall and actually went up in value. And this can be looked at right here because um, in 2020, you see this peak. There's a mountain that's above the zero line, right? That means there's outperformance that was generated by gold as a security against that of the index itself, right? Come 2021, this underperformance started when actually equity markets started outperforming. Right? You see this crossover happening between this blue line and this black line. This is typically indicating that the benchmark, which is in this case, of course, the index, has started outperforming gold as a security. And you see this is the underperformance that gold ultimately had. Right? So this extreme up move that was experienced by gold was typically during that volatile time of COVID onset, right? And you can locate that right here using this cumulative outperformance chart. Now, this can also be seen in up capture and down capture ratio. It tells you what was the movement or what was the impact on the returns of the security that you're analyzing when you compare that with a benchmark in a specific time period. Of course, in up capture ratio, it will consider only those months when the benchmark, which is the, of course, in this case, the index, given positive return, right? You will not see a single month here when the benchmark given negative return. You'll only see those months when the benchmark actually given positive return. So for example, in Feb 2021, Nifty 50 given 6.64% return. On the other hand, gold given negative 5% return. And this you can also see in the latest past, right? So in July 2024, right? Or for that matter, August. There's only one day of August, but Nifty 50 given 3% return. On the other hand, gold, there was a, price of gold actually slashed, right? And that's what is indicated right here. Gold fell in July of 2024 by a 3.42%. Right? So this can be seen in the up capture ratio. What was the impact on the security that you're analyzing against the up move of the benchmark itself? right? Exactly opposite is the logic of, for that matter, the data that you can see in the down capture ratio, which will let you see how resilient was your security when the benchmark or the index that you're comparing it with was falling, or rather was in volatile time, right? The moment you click on this I button, you will typically see all of those COVID periods, right? COVID onsets. For example, in the month of May, or for that matter, March, right? The benchmark fell by 23%. On the other hand, gold only fell by 3%, right? All of these you can see, for example, in the month of April 2021, benchmark fell by negative 0.25. Gold, on the other hand, gave a up move of almost a 7%. So this is down capture ratio. You can check the down move of your security against to that of the benchmark. Now, in this case, of course, we are analyzing this for commodity. You could analyze in the same manner for any other asset class as well. So it could be a AIF or it could be a foreign equity as well. The analysis will exactly remain the same. It's just that the commodity will change, or for that matter, the security will change. Now, let's move forward towards distributions analysis, which was again a topic of discussion, which is available right here in this security analysis. Now, first of all, let's understand what distribution analysis typically aims to do. So this is, first of all, it's a statistic measure to actually see what um, pattern of distribution does the returns of a security follow. Theoretically speaking, um, in statistics, it's always considered normal distribution, but in practical life, no returns are normally distributed. They're either skewed on the left hand side or on the right hand side, which we'll understand all of this. But let's first understand the parameters that are really considered when we are doing this distribution analysis. Right? The moment we land on distribution analysis, you will see that total number of observations under consideration will be mentioned on the left hand side. So now what do we mean by this? We mean that from 30th of July 2019 till 1st of August 2024, we have 1,133 working days, right? Typical days. These are the number of days under consideration. Now, why is this showing in number of days? That's because in this drop down, which is called return period, we have chosen 1 day as the return, right? You, of course, have the option to change it to 1 week or 1 month, but currently, let's keep it as 1 day. So observations is typically the number of days under consideration in this time period. Next, this number of intervals that you can see as a measure is currently set as 10. Now, what does this mean? This means that on the x-axis that you can see, the buckets in which the intervals will be divided into, or there will be a number of intervals that will be equivalent to this amount that you put right here. So in this case, there are 10 intervals. That means the x-axis is divided into 10 buckets, in which all of these 1,133 observations will lie. Now, of course, you can increase these intervals to up to 10,000, right? For an use case scenario, let's consider 20, right? So I change this to 20, and now you will see, just keep on focusing on the x-axis. This will now increase to replicate 10 more, right? So it's currently set as 10. We now make it 20. You see the x-axis further gets divided into 20 intervals. Now let's consider the tallest bar graph that you can see right here. That is typically the interval, the return interval of negative 0.25 to positive 0.67. In this interval, there are maximum number of observations. You see there's a frequency of 619 in this return interval. That means out of this 1,100 odd observations, 619 observations lie in this return range. That means the prices of gold, or rather returns of gold, ranged between 0.25 to 0.67 in a single day, 619 times, right? 619 times the returns of gold, single day returns, mind you, range between negative 0.25 to a positive 0.67, right? And this happens to be called as the tallest bar graph. Therefore, this is called the modal frequency. You will see this return range, that's 0.25 to 0.67, being also called as the modal frequency. That's the frequency which backtests, or rather which has the maximum number of observations. And of course, you can get this when you just scroll or rather hover on this question mark. It is the most commonly occurring interval. That's the tallest bar graph. On the other hand, if we hover on the extreme right hand side, right? So this is a frequency of 5. That means there were 5 such days. Frequency is nothing but days, right? Observations in this case, because on the drop down we have days. That's why I say 5 days, right? There were 5 such days when the single day return of gold ranged between 2% and 3.5%. Right? Now, where am I getting this from? So you simply, try to hover on this particular bar graph, and you see this, data set right here. Of course, when you, zoom in further, you can see also there's this very small bar graph here as well. So that's the highest frequency. So you see, there was one such day when the single day return from gold as a security in the time period of last 5 years actually ranged between 4.39% to 5.33%. Right? So this is the best case scenario. If you now want to have a look at the worst case scenario, you simply reset it back, and now you'll be focusing on the left hand side, because that's the worst case scenario, right? So that's the worst negative return. So how much was that? So you simply try to zoom in here, and we see there were 6 such days in the last 5 years when single day return of gold as a security ranged between -3 and -2. So in one single day, it fell that much, right? And there were 6 such times that it fell in this range, right? So this can also be extrapolated for all mutual funds, or for that matter, all portfolios, which will typically help us in understanding what was the observations, or what was the best case scenario, that what is the highest return that a particular fund can give in the entire time period under consideration. On the other hand, what is the most probable, or for that matter, what is the most likely return, which is the modal frequency? What is the maximum number of times it has ranged in that particular range? So for that, if you want to extrapolate that on a mutual fund, we've just loaded in a mutual fund here. So you go in a single fund analytics, and there's this distribution tab right here also. Right? So in this case, again, we are doing this a 5-year analysis. Of course, it's June 2019, so that's just 1 month more than 5 years. In this case, the number of observations is 1,265, and the modal frequency happens to be between single day return between 0.065 to positive 1.83. And out of 1,200 odd observations, 760 days were such when this fund, that's Bandhan Sterling Value Fund, actually gave in returns between this range. Now, I'm saying all of this on a daily basis. Of course, as we mentioned earlier also, you have an option to change it on a monthly basis. So for example, if you want to have a look at monthly returns in this entire 5-year period, you can simply change the toggle between 1 month, and you can then see that, okay, in this 5 years that we are analyzing, there have been 64 number of months. Out of these 64 months, 34 months were such when single month return of this fund ranged between 1.5%, that's 1.45, to 8.30. Right? And that 53% that you can see in the bracket is, of course, percentage, right? 34 divided by 64 is 53%. So, right, how much of the observations lie in this modal frequency? So this can also be extrapolated on a portfolio level. The methodology or the interpretation will remain the same. You simply need to load in a portfolio from here. For example, let's say this existing portfolio. You run this analysis in detail, and the fourth last tab will be distributions tab, which will of course have the same layout, and you can draw the same conclusions from this. Right? So this one returns distribution analysis can be used not just on a security, custom security that you're analyzing, but also on a mutual fund and even on a portfolio of mutual funds or stocks. Now there's one more thing that it tries to communicate, which is the frequency table. Now this frequency table tells you that what rather how many number of days typically did it actually give in positive bucket, and what were the number of days it gave in negative bucket. You can definitely download this table and it will give you the count right here. So for example, let's do this on a monthly basis for, of course, gold, because this is the security that we're analyzing, and we say run. So you see, there have been 15 plus 14 plus 7 plus 4. So many number of days, so many number of months out of 60, gold as a securities return was in negative. On the other hand, 9 plus 4 plus 5 plus 1 plus 1, in these many months, it was in positive, right? So this is what the frequency table indicates, and you can, of course, download this. The same thing is also available here in performance charts. If you want to see which were these months, right, when it actually, went in and actually gave in the extremely stupendous return of 4%, or for that matter, 12%, right? So you go here in the performance tab, and at the bottom, we have this monthly statistics. If you want to see the best return, when was it given? So that was given by the security that we're analyzing in the month of June 2020, when monthly return or single month return of gold was 17%. Right? So you can, of course, make this out, but this is available on a monthly basis only. If you want to check this on a daily basis, or for that matter, weekly basis, this will be available in the distribution chart by using this toggles. Now let's understand the last parameter that is left, which is skewness. Now skewness typically tells you towards which side are these returns distributions tilted. Right now, just by the look of it, or just visually speaking also, you see this positive tail of this particular security that we're analyzing seems to be a longer one, right? You see there are more observations, elongated observations. The On the right hand side, it is stretched, right? Therefore the skewness of this particular security is positive. For a normal distribution, skewness is always 0. So the moment you see a skewness that is more or less than 0, that typically means the data is not there's no zero skew, right? The data is skewed, right? In this case, there's a positive skew. That's why you see there is a longer skew on the right hand side. On the other hand, on a mutual fund that we were just analyzing, there's a negative skew. Visually also, you see there's this longer negative tail than the positive one, right? This typically means that the skew, that means the number of times it has gone negative, is more, rather out counts the times that it has gone positive. Also the value, right? So skewness, if that's negative, that typically means it has a longer negative tail. If it's positive, that's a longer positive tail. So that's the interpretation of returns distribution. Now, typically, let's move towards understanding the latest updates that we have done on NGEN Markets. There have been multiple updates at multiple places, small updates. So first of all, let me start off from the share link, right? So initially, on a portfolio level, you could always run a detailed portfolio analytics and share link for a maximum of 7 days. That is still valid. But now, when you click on this create link, once this link is created and you share it across with the client, he has done his review, let's say, temporarily, and the 7 days have expired, right? You want to reshare it. You do not need to again go and load in the portfolio to reshare the link. You can now click on share links at the top. So this is the option. You click on this. These are the desktop links and these are the mobile links. Let's say you want to reactivate this for a once after it has expired. You can simply click on this reshare icon or make this active again icon, and again the link will be active for the next 7 days. So you can reactivate that shared link for next time period of 7 days. So this was a small update right here. Next, if you see in the compare section, if you load anything that is not a mutual fund or a stock, it will be color coded into blue to indicate that, look, this is not a mutual fund. This is the index that you're comparing it with. For example, in this case, we've loaded in a fund, right? That's Bandhan Sterling value. Now, if you want to, let's say, compare it with, let's say, Nifty 500, which is a benchmark, for that, you simply go here and load in the benchmark, right? So that's Nifty 500. And when you click on this, it will be color coded as blue, right? So same is applicable with category averages, because those are also benchmarks. Those could be used as a benchmark as well. So let's say now you want to load in value as a category average. So you search for value as a category, all the value funds under consideration, this is the category average of that. Again, that will also be color coded into blue. Another small update that we have in the compare section itself is this toggle that you can see. Previously, this toggle was available in the funds section only to typically choose between direct and regular funds. And this was not available on the compare section for funds. It was always available on a security, meaning add a groups. On a group level, it was always available. But we received a lot of feedback from our IFAs saying there could be a lot of confusions as to if both the direct and the regular plans are shown together. Now, if you have this regular toggle selected, if you choose any fund, right, or rather if you search any fund, it will only show the regular option only, right? So for example, ICICI Pru blue chip, right? It will only show you the regular option. The direct option will only be, of course, will visible when you choose the direct toggle. Next, we now have enabled sorting option in the query tab, right? So we had introduced this query tab almost a couple of months back. The use of this is typically more advanced version of the screener tab, wherein you can add multiple conditions and use all of these conditions to screen funds and take them to the compare section, right? Now, when you use multiple such conditions, all of these conditions definitely got added here, but sorting was not enabled, right? That caused some, basic inconvenience for the clients, and then we have definitely enabled those sorting options. So for an example, I'll take a quick example before we proceed. So for example, SEBI category is, let's say, contra funds, right? I add a condition. Now I want to have only those contra funds which typically, have a Sharpe ratio of, let's say, 0.25 and above, right? So I add a condition saying, okay, Sharpe ratio filter. And I'll say, okay, between 0.20 to, let's say, 1.50. I say add a condition. All of these three funds meet this parameter, and I say show these three funds. The Sharpe ratio as a parameter gets added here, and this could be sorted now. Right? So this is what we've incorporated. Also, there's a bug fix that is made in this Excel downloads. That was, of course, always there. This condition that you add did not get exported. So we've now enabled that export onto this particular, download. So when you click on this and it gets downloaded, just 1 second, it can now be visible. As you can see, this gets exported. Right? That's one more bug fix that we've done. Other than that, just give me a minute. Is my Excel visible? Sorry, can you please confirm if my Excel sheet is visible?
Yes, ma'am, it's visible.
Oh, all right, all right. Okay. Okay. Other than that, we've also made some small fixes in the client section view, wherein if clients had multiple ARNs, from the toggle they had to choose consolidated, and only then it could, it showed up a consolidated view. Now we have changed the default view to consolidated, and if you have multiple ARNs, automatically a consolidated AUM view will be visible, right? Of course, you can toggle and then choose to view only one of the ARNs, but this is what will load by default, right? Other than that, if you're looking to download drawdowns, right, in Excel sheets. So that was not typically available before, right? You always had to take screenshots. We have now enabled Excel downloads in drawdowns as well as in risk versus return, right? So in risk versus return, in the compare section, of course, Excel downloads are enabled. Now this drawdowns download is enabled not just on a fund level, but also on a portfolio level. So you go to a portfolio, you load any portfolio, you see drawdowns, Excel is enabled. Other than that, there's one other update that is made in the PPT option of a report, right? So for example, by default, as you would be aware, in a PPT, when you download that, default master slide always comes in with default engine colors, right? It will be a blue colored master slide that will be visible in all of the PPTs, right? Now we've given you an option to change that as per the color palette, or for that matter, the color scheme that you would have or your organization might have. I will quickly show you how do you change that. Just give me 1 minute. Yeah. So when you download a PPT by default, the slides are of blue color. If you want to typically change it to a red, right? Because that happens to be the color palette of your logo, right? Then you simply go this settings tab at the top. There's this colors sub tab right before RTA connections. You go on this colors sub tab and you change your base color. You click on this color palette. You, let's say, want to make it red, right? So you go here, you say, okay, red is the color that I want. So you choose this color and you say, okay, change. Right. So now, of course, in addition to this entire layout of NGEN Markets changing to red, now if you typically take in any PPT reports, that will have red color incorporated, right? So I will quickly show how that looks like now. Look at this. This master slide color also can be changed now. These were all the updates. Typically, if you have any further questions, now the forum will be open for a Q&A session. Thank you for your patient listening.
Hello.
Yes, please go ahead.
I have one feedback. In client section, where you have the portfolio of various clients.
Yes,
My feedback is now generally these clients will be from a single family, different clients from different family.
yes.
So whether it is possible, or if it is not, you can take it as a feedback. I can group members of the same family in a single group
Hmm.
so that for example, Patel family is there in which
Yes,
husband, wife, mother, father and kid is there. So I
yes.
can group that in a name called Patel family,
Yeah.
and that will be saved in the platform, so that every time I don't have to create the group of that Patel family.
Okay, look, so we definitely have the feature wherein you can run analytics on a family portfolio by clicking on this load multiple clients.
That I know, but every time I
Yeah,
have to, choose do that do this process again and again. In that case, if I have already saved that, made that group family wise, then it would
yeah.
be easier for me to, always not to do the process again and again.
Sure. So what happens is the RTA feeds, right, that come in CAMS and Carvi, these get updated, twice a week, right? Even if we give you that option to save, currently we're facing that challenge when there is a automatic feed update that will happen. The saved portfolio will go away, right? So typically you will ultimately have to do it again whenever the update happens of your CAMS inquiry. That's one small technical challenge that we were facing, but sure, we will have a look at this. I will note this down as a feedback.
No, that's fine. That's fine by your end. But normally there are some platform where we can manually, in your platform also there are option where you can make clients portfolio and save it internally. So in
Yes.
that manner manually we can, if some member is added, then
Hmm.
definitely it won't be added automatically. We have to first merge that new member into that family. Then and then only it will show. But that has to be one of the facility or a feature.
So typically, this is a feature that is offered by and large in back office platforms, not in front end research analytics. But sure, we understand the concern here. We will try to fix this, maybe by giving some option, not in the clients though, maybe in the portfolios section, wherein you can save family portfolios. We will note this down as a feedback. We'll have to work
Yes,
around
yes,
it.
yes, yes.
Yeah.
But just for the information, this Morningstar which we were using previously has that feature. We can group families and save it, in different files.
We'll have a look.
Sure. Thank you.
Hello,
Yes.
ma'am. I have a question, but I don't know whether it is not maybe exactly relevant to the topic of
No
discussion today.
problem.
What
No
we are.
problem. Yeah.
Uh, I I basically want to see comparison. No, like say if a customer has an existing portfolio, may
Yes.
may not be with us
Okay.
externally. So how to upload that the cash statement and then start comparing it with a model portfolio? That is something which I want to learn.
Sure, understand. So typically for two portfolio comparison, you would be going here in the compare to portfolios tab. But before that, let me quickly explain the procedure of adding a prospective client's portfolio, right? Now, how will you add a prospective client's portfolio onto NGEN Markets? So for that, we have this statement analyzer option. The moment you click on this, a new window will open up, which will let you onboard NSDL, CDSL, or CAMS ECAS files, right?
Okay.
You choose that file from your desktop. You put in the file password, which is generally the PAN number. Once that is done, you click on check file.
Okay.
Once that is done, you will see this file will appear like this on the right hand side. All of these are ECAS.
Yeah.
Now, this is of course provided the client gives you his ECAS. Now, this is a prospective client that we are speaking about. Let's say he
Mhm.
has some reservations giving his ECAS, but typically has shared maybe his holdings with you. Then you can alternatively create his portfolio manually or through ISI numbers also. This option can be used if he shares his ECAS with you.
Okay.
Once this ECAS is uploaded, you go back to NGEN Markets platform. You onboard his ECAS using this add a new
Ma'am,
portfolio
one minute,
icon.
1 minute. You
Yeah.
said first what should I do? I should come to the portfolio there for new prospect to be added.
Okay. So
Portfolio
for new prospect to be added, you need to first of all visit this statement analyzer tool.
statement analyzer. Okay.
Yes.
Okay.
Right. You
Got
need
it.
to upload the ECAS.
Hmm.
Once the ECAS is uploaded, go back to the NGEN Markets platform in the portfolio section. There is this add a new portfolio icon.
Yeah.
Click on this. And because it's from an ECAS, you choose load statement analyzer. You
Okay.
will see all the ECAS that you have uploaded onto NGEN Markets. So now let's say you want to compare the Smith Agarwal's portfolio. You
Yeah.
click on this plus icon. All the holdings from his ECAS will be uploaded onto NGEN Markets like this. Right now, this happens to be a mix of stocks plus mutual funds
Yeah.
because it is from an ECAS statement,
Hmm.
which will capture both NSDL and CDSL ECAS. Right.
Hmm.
Then you will save his portfolio. Let's say now we are going to rename this as, let's say, Smith Agarwal August.
Hmm. Hmm.
Right? And then you will say create.
Hmm.
Remember to click on create, only then the portfolio will be saved onto NGEN Markets platform.
Okay.
Right? Once it is saved, it will start appearing here.
Okay.
Right? Now, you want to compare it with one of your model portfolios, right? For that, you will click on this compare to portfolios icon, that balance icon that you can see in the portfolio section itself.
Yeah.
You go here and it will load two portfolio side by side comparison. Now, the prospectives existing portfolio always has to be loaded on the left hand side, right?
Okay.
So this is where we will load Smith Agarwal August. Now, on the right hand side, you will load your model portfolio, or for that matter, the target portfolio that you're trying to pitch to the client. That, of course, you would have saved using the entire screening process, selection process, allocation process on NGEN Markets. So funds compare section, right? You load that model portfolio here. So I'm going to load in a test portfolio. Right? That happens on the right hand side. Once this is done, you choose a start date. Let's say you want to show this analysis for the last 5 years, right? So you say 1st of August 2019 and you hit go. This is your two portfolio side by side comparison. You're comparing the Smith Agarwal August portfolio with your model test portfolio. And then all of these parameters will be visible. You can, of course, take reports out of this. There are PDF reports. You can take a download of this. Standard PDF will be in percentage terms, and all the PDF PPTs will be co-branded. This is how the report will look like.
Fine, man. Great.
Yeah. All right. Any more questions? Please let us know.
No, there is a correlation tab. Will you please explain how to interpret that?
Sure. So
Correlations.
yes, sure. So for example, let me load a couple of funds. I'm going to typically load in funds from different categories. So let's say iPro, blue chip. Let's say GM, liquid fund. Right. So these other three funds, I've purposely loaded them from different categories. Equity will have, low, very, very low correlations with liquid and of course gold, right? That is why they are included in portfolios to achieve diversification benefits. And this is exactly what you can see in numbers in the correlations tab. Now, the moment I hit on correlations, you will see iPro blue chip, right? The NAV of iPro blue chip, which is a large cap fund, has zero correlation with a JM liquid fund, which happens to be a liquid fund from debt category, right? So movement in iPro blue chip will have zero impact on the movement of JM liquid fund. On the other hand, the correlation between iPro blue chip and Kotak gold fund is negative. That means when NAV of one is going up, the NAV of other is going down, right? So that's negative correlation. So correlations as a number typically talks about how directionally similar are the NAVs of pair of funds that you are considering. Because these were funds from different categories and typically very contrasting categories, you see very, very low correlation numbers. Now, the moment I load something like another large cap fund, right? For example, HDFC Top 100, I will start seeing very high correlations between them. Now I hit on correlations. You see, the correlation between iPro Blue Chip and HDFC Top 100 is very high. That's 0.97. That means if the NAV of iPro Blue Chip is going up, 97% of the times, NAV of HDFC Top 100 is also going up in the same direction. Now, please note, we are not speaking about magnitude here. We are not saying that if iPro Blue Chip goes up by 1, HDFC will go up by 0.9. No, we're just saying that we'll go in the same direction. That means if iPro is going up, HDFC will also go up. That is what higher correlations mean. Correlation as a number ranges between -1 and +1, right? So the closer it is to +1, the stronger is the correlation. The closer it is to 0, that means that's no correlation. And closer it is to -1, that's exactly perfectly negative correlation, right? So one is going up, the other is going down, like that.
So what is the interpretation here? When you're choosing a fund, there should be no correlation so that each fund is uniquely diversified.
No, not like that. You cannot typically, I mean, if you're choosing, you cannot say that this is a rule of thumb, because if you are, analyzing a portfolio which has, a couple of large cap funds and some other funds from equity category, they will have correlations more than 0.5, 0.6, 0.7, in fact, right? But if the components in the portfolio are such that it has like this, right? For example, like this, then it typically means the portfolio is very well diversified, because you have one from every category, like that. So, I mean, there's no rule of thumb, but um, lower correlations will typically mean the portfolio is better diversified, like that.
How does this actually help us in taking a decision about the funds?
Sure. Hi, this is Aruna. Yeah, the one way that it can help is if you have a portfolio, let's say a portfolio from a client, one thing you can do is run this correlation analysis and check what kind of what the correlation matrix looks like. If it is full of basically dark greens, that's not a good sign, because that means they have too many funds which are very similar. Obviously, as we explained earlier, this number is between -1 and 1. In most cases, you will find it positive, because they are mostly all equity funds, etc., or even with debt funds. So the way it helps you identify is if you have very, very high correlations between 2 or 3 funds in your portfolio, it's probably better to try and remove that. Sometimes, because of the kind of requirement you have, kind of portfolio you're building, the kind of return you're targeting, sometimes it's not possible to remove all the dark greens. Sometimes you have to have some positively correlated items in there. But it's kind of a safety check, in the same way that the portfolio overlap is a safety check, because you can see that you can kind of make sure that if you've invested in 10 funds and most of them are holding the same stocks, it's kind of useless. So the way this helps you is that it helps you identify whether or not your portfolio has diversification problems. So here you can see, for example, in this portfolio, overlaps are very small. So that's good. There's only a little bit, which is 29%, is not that much. So you can click and see which funds are common. So this is a decent view. But then when we go to correlations, which is based on returns only, not the underlying holding, you can see some of these funds actually have reasonably high correlation. Like you can see 0.85 over there. That 0.85 probably refers, yes. So it's Nippon India Large Cap and Axis Growth Opportunities Fund. Even though their holdings are not very similar, the underlying stocks they have are correlated highly to each other. So at the end of the day, they are moving quite similarly to each other. So this is it's a safety check.
Okay, great. Thank you.
In case there's nothing else, you can close for today.
Yes. Yes. Thank you so much for joining in. You can definitely um, yes, you can definitely view the webinar recordings, past webinar recordings from our YouTube channel. The link for which is right here under the platform. You click on this and it'll be taken, you'll be taken to the YouTube channel. There's a dedicated playlist that is created for all the past week webinars. You can definitely visit that and have a look at the one that you might want to revisit. So thank you again for joining in. We'll meet you next week with a new and more interesting topic. Till then, do stay tuned and have a great weekend ahead. Thank you. Sure. We have noted down your comment, Mr. Nagaraj. I'll get someone from the team to give you a call.